Hi, everyone. Welcome to the 129th episode of the Timing Research Show for March 13th, 2017. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be discussing the 181st weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com, and you can download this or any of the past reports there. I have Dave Landry back to host today, so I'm going to go ahead and turn it over to him.
Thank you, David Kosmeter, and thanks again to Timing Research for having me back once again. I'm honored to be here. As I often say, I love doing these shows because I often learn something myself. So from a selfish standpoint, that's why I like doing them. We have a couple other people that are supposed to be here. Well, Jim's supposed to be here, and I see him here, but I know he's had some technical difficulties. So I don't know if you can hear me now, Jim, but don't worry if you get your computer rebooted or whatever you have to do. We'll let you join in progress, obviously. And Glenn, we haven't heard back from Glenn, so he might be having some technical difficulties too. But same thing goes for Glenn. We'll just catch him up. Steve?
Here we go. That's okay.
That's okay with me. That's fine. Well, tell us a little bit about yourself, Steve Lentz of OptionView.com, and you got plenty of time. Say whatever you want, and tell us a little bit about OptionView.com for those of us.
Well, certainly. So OptionView Systems was started in 1983. Our founder and president is Len Yates. And for all this time, OptionView has occupied a unique niche in the options trading world of high-end options analytics. And so the modeling of future theoretical prices with everything, including the kitchen sink, thrown in to make it as accurate as possible. That's what we're all about. Then we have an educational arm called Discover Options, and we focus primarily on the one-on-one mentoring approach to learning options, and we'll take anyone from beginning, intermediate, up to as advanced as you want to go, managing money, etc. One thing we rolled out recently that's kind of interesting is called the VXX trading system, where we have a timing approach to moving your money from the VXX to the XIV or into cash. And we've developed some proprietary in-house indicators, and we disclose the philosophy behind all those, and that's VXXTradingSystem.com. And cool. So that's something we are into right now as well.
Well, a lot of moving parts with options, so that's good to have education and tools, obviously. For those of you guys who don't know me, Dave Landry from DaveLandry.com, occasionally hosting this show. I believe that you can only predict the short term, but you can stick around much longer if the trend moves in your favor. And I do that through a hybrid approach to money management and position management, where I take partial profits and then trail a stop more loosely. You can only, again, see so far out in markets. It's akin to predicting the weather. If it's cloudy and thundering like it looks like it is here, it looks like it's going to rain soon, but I don't know if it's going to be raining this time next week or next year. So you can only predict so far out no matter what anyone says. And that's why I'm slotted as a short-term trader or a swing trader, but I'll stay with positions as long as they're moving in our favor. In fact, we had one stop out recently. We've been in over a year, I should say. Anyway, if you want more information, I have free reports on my website. And then I think it's up now. If you go to DaveLandry.com, timing-research-special, kind of a long thing. Maybe David Kosmeter can get that out. There's some special offers for you guys that are watching today. Looks like it's the Dave and Steve show, which is fine with me.
Dave, I just got here.
Oh, hey, Glenn, how's it going, man? We were just talking about you. So,
yeah, apparently one of my plugins has expired and it wouldn't allow me, so I figured out a shortcut. So, yeah, I got to update a plugin. Sorry about that.
No worries. We were just talking about you, but most of it was fairly nice. Anyway, for those of us who don't know you, Glenn Thompson of Pacific Trading Academy, easy for me to say. Glenn's a veteran of the show. We're happy to have you back yet again. Tell us a little bit about yourself and your trading and PacificTradingAcademy.com. Thank you, Glenn.
Sure. Thanks. Glad to be here once again, everyone. I've been working with PTA, Pacific Trading Academy, since the beginning. That's a little more than 17 years now. Before that, I've been trading, I guess, 30-some years. I've lost track, but primarily technical analysis. I started fundamentally. The very first book I ever read, Fundamental Analysis, but I couldn't make any money that way consistently. So when I began to incorporate technicals,
I use that book to make me look taller when in these webcasts.
curiously, I understand it. It kind of it humbled me. It took me more than a year to get through it because I didn't have a background in finance or economics at all. But so I needed other references and sources to kind of get my way through that. But that was many eons ago. But since then, by integrating technicals, I began to have a clarified understanding of things and a little more consistently, at least, achieve success. But again, I teach primarily technicals, standard John Murphy type analysis. I do a little, in my own accounts, I still trade primarily the E-mini and indices, and I do a lot of Forex as well. So I've worked with beginning traders, intermediate experts, everything kind of. I'm also conversant with option strategies but short-term, long-term, all of the above. I primarily trade derivatives though. So I don't focus primarily on stocks, even though I started there as a broker, trading equities and options on stocks. But primarily, as I said, the E-mini, S&P, and Forex markets are the focal point of where I look.
Cool.
Yeah.
Cool. Yeah. It's kind of interesting. I think a lot of people start with fundamental analysis. And I remember when I first got started, I was explaining what technical analysis was to someone who was asking. And I'm like, it's like, well, they seem to think that you could just look at charts to predict the market and you don't care about earnings and all this other stuff. And I just thought that was crazy. And then the more I tried to figure out fundamentals, the more the charts started making sense. I think we all kind of start, at least at some point, dabbling with some F word. But anyway, Steve, let's go to you. F word is fundamentals. That is a joke. Which direction you think the S&P is going to head from today's open, obviously, which we already know, close, and then in the next question, we'll ask you about some developing events. Also, two things real quick before we get started, Steve. If you want to share charts in the next segment, feel free to do so. You just hit the share button on the left side of the screen. It's a little pop-up that should come up. And then also, towards the end of the show, if you have a trade of the week, let us know, and we'll be happy to let you put that out for us. Or we would like for you to put that out if you have one. Anyway, go ahead, Steve. Up or down on the S&Ps between now and Friday?
Yeah, let's. Do you want me to give the analysis and the reasons now, or
if you want? But we'll get to that in the next segment too. Just up or down, and then rate your confidence to that by estimating that you have correctly predicted this week's move.
Yeah, I'm going to say down 60% confidence.
Okay. And then let's hop over to you, Glenn. Same question.
I think that's every now and then you get one of those odd coincidences. I thought I would be the lone bear today for the market, playing a contrarian view, and exactly at I guess Steve's percentage. I am 60% bearish, and I thought I would be amongst all the speakers today the odd person out. I have a lot of reasons why I'm intrinsically bullish this market. I actually established a short position as a position trade. I think it was last Thursday, basis the June S&P. So I'm short from 60. So I'm underwater right now at 23.60. I think we're trading around 23.72 right before I checked in with you guys area. But I am expecting by Friday we'll be lower than we're currently trading, and I would give it about a 60%. Curiously, the same assessment as my predecessor. Yeah.
Well, I'm going to be the lone bull, and I'm going to go up, and I'm going to give myself 100% confidence on that, which is I get some chuckles. Yeah, it's kind of silly to give yourself such a big. I'm obviously being a little tongue in cheek with that, but I want to go against you guys just to be a little contrarian here, and not for the sake of being contrarian. I often say, as I said a few minutes ago, you could only predict the short term when it comes to markets, and a few of my clients misconstrued that into that you could always predict the short term. Well, if you could always predict the short term, you would be the richest guy in the world. I like to err on the side of the longer term trend, and when we show shorts in the next show charts. Boy, I hope that wasn't a Freudian slip. When we show charts in the next segment, I'll show you what I'm looking at in the S&P, and then we'll come back to developing. But let's do that now, Steve. Let's if you want to share charts, fine. If not, you want to talk through your analysis And while you're a bit of a bear there, feel free to do so now.
Well, let's see here. So what do I do to hit share?
If you go to the left side of your screen, you should get like a little pop-up. And then we could go over to, we could pop over to Jim if you have any trouble getting that.
You know, I'll hit screen share, see what happens, right?
And then you should see your quote feed is possibly one of these, or one of the screens. Or
oh, there it is. Let's go there. Start screen share. All right, can you see my Metastock? Beautiful, yeah. All right, so I've developed a system in Metastock whereby I can look at a certain market condition, and I go back in time and I just look at the price distribution from those times in the past when the same pattern occurred. And so what we have going on here as of Friday's close, we had a downswing day on Thursday and then an upswing day on Friday. You can see that on the far right, the green diamond and the highlighted bar. We're above the 50-day moving average, okay? And in the 15-3 stochastic, we are between 30 and 70, and it's trending downward underneath its 3-day, percent D there. So that condition has occurred about 65 times in the past, something like that. And so generally, and then what I've done is I take distribution bands, basically 5, 10, and 15-day bands from each day's close, and we see how often price goes up and hits the upper 3 or the lower 3. And in general, the bullish bands are struck one time in 4, and the bearish bands are struck one time in 4. But this condition that I just described for you and I'm showing you here results historically of those 65 times. The bullish bands are struck one time in 5, and the bearish bands are struck one time in analyzing, just to take the analysis just to the basic here. So does it mean that the market's going to go up or down? What it's saying is that there's a greater likelihood, judging from the past, that there's a bearish bias here, judging from the past, that the bullish bands have a less likelihood chance of getting struck one time in 5, and then the bearish bands are one time in 3. So that's why I'm leaning bearish. It's just because of the pattern history with regards to where the market is now. Gotcha. Hey, Glenn, did we get your answer to number 1 or 2? I'm sorry with the technical difficulties. I'm a little mixed up.
Sure. To number 1, I'm the same as Steve. I'm expecting a lower price at the end of the week, and I would give it about a 60% expectation.
Okay, I just want to make sure I didn't write that in the wrong. And Jim, you were the same, or did we get your analysis on that? Or is Jim not hearing us again?
I think he's having problems with his microphone.
Okay. Well, yeah, my mistake is what I wrote. I thought Glenn had answered. I put his 60% under Jim's, and that's where I was confused. I didn't know whether Jim was coming back. He'd come back in or not. Okay. Glenn, did we get let's get your developing events. What developing events? Let me read the question so I make sure it's I read it right, just in case something changed in the last week or so. I had these memorized for a while. For your answer to, I guess, 1 and 2, please share what specific reasons you think the S&P will be headed lower.
Sure, and I'll hit the screen share, so maybe a picture is worth something.
Amen.
Hold on. Let's see here. Can you see the?
It's very profound.
Can you see this? This is. I also am utilizing a Metastock platform. Can you see it? This is
not yet.
No, you're not.
All right, hold on. Let's. Let me hit the screen share. This is the handout. So up, you guys. Am I still with you?
Not yet, but if you want, I could do my analysis at your little window.
Can you?
What you'll see the chart. So why don't you keep working on that?
Yeah.
And then I'll start with mine, and then we'll come back to you, just to keep the continuity flowing. Okay. Now let's see. Now am I sharing? Okay. It looks like I'm sharing. Okay. Let me pop over to mine. It is a little cumbersome. Well. The reason I said higher, first and foremost, is one thing I say is when you're near or at all-time highs, and we're just a little bit over % change off all-time highs, I like to err on the side of longer term trend. And I think it'd be some fun analysis to go in and say, okay, look, we're near a new high here. We went on to make new highs. We're near a new high here. Went on to make new highs. It'd be fun to go back and look at the S&P throughout history, or any other market for that matter. Obviously, we've been headed higher for a while. I'm known for drawing a big blue arrow on the chart. Somebody once called me a trend-following moron, and the name stuck. They didn't mean it as a nice thing, but I got the T-shirts and the buttons made and everything. One thing that I like in more recent times is this market has been very persistent, and that's a pattern in and of itself I call persistent pullbacks. It's really nice. Not as great in something like the S&P 500, but more so in individual stocks, and a lot of individual stocks have that. Now, let me just, for those of you who are more techy involved, this is mathematically equivalent to linear regression. So if I drew a linear regression, it would look a lot like the line that I just drew. But I just like to draw a trend line through as many bars as possible. And those people who know or familiar with classical technical analysis, you'll see that we have a bull flag here. So this is why I think we're headed higher. I think we're going to rally out of this little pullback here and go on to bang out new highs. Everything I do, in case I didn't allude to it enough, is technically based. So I believe that the technicals lead the way. And technical analysis, in my form, is more of just looking at the charts to read the psychology of the other players, and of course controlling your own when you go to act upon that. And I think it's all there. Unless you're Bill Clinton, what is. If a market is going up, it's going up. You can't really argue with that fact. And I don't try to outsmart it too much. Again, I just kind of follow along as a trend-following moron. Okay, Glenn, any luck getting your screen shared over there? Let's see.
I'm clicking the screen share. All right, so I've done that. It says, it indicates that I have it in effect, but when I click on my chart, like now, are you able to see it?
No, not yet. What'll have to happen is
let me give a verbal then, and as best I can.
Okay.
Kind of, and coming on the heels of what you just said, Dave, and then thou almost makest me a believer, and I am an advocate and disciple of the trend, and this is why I kind of qualified my prediction or forecast or projection in that I am intrinsically bullish the market, and certainly longer term, going out for the next year or so, I still expect higher highs to achieve. But again, shorter term, between now and the end of the week, I expect a pullback. So,
well, I respect that, Glenn, because you said, look, I know I'm fighting a trend, but this is what I'm thinking. So
yeah, and I agree with your point. I'm similarly a trend following moron in a sense. But here's the thing, as I see it right now, specifically in the stock market, the trend is your friend until it's not. And at some point, it's gonna there's a terminal point corresponding to a new trend onset. I believe that terminal point was March 1st. And again, I wish I had a graph in my chart to show what's going on. I had a few weeks ago projected a top the actual top that we see on the screen right now on March 1st in the major indices, and I'm looking at the S&P, basis the March contract. Now, if I were trading, I'm in June right now, but a few weeks ago, I was still looking and evaluating March. I had a price target of 2401. We actually hit 2404, so we came close. As such, it was not a perfectly precise generated target, but it was close. More important to me is the timing. Timing is kind of my subset of analysis, and the premise being a market's going to do what it does once its time arrives. We've been declining since that into, I guess, Thursday's low. Here's what I look at to kind of assess the trend strength and the likelihood of a reversal occurring and a new trend starting. Watch and measure the pullbacks or retracements to a given thrust. The idea is if you have a succession of rising thrust, how deep are the pullbacks or the retracements? Shallow pullbacks on the heels of major, rising off of bottoms tend to indicate the trend is going to persist. If you have the more deep the pullback, the more likely an indication you see correlation to kind of a petering out of momentum. So, and then the opposite is the case. If I've got off of tops, if I've got deep pullbacks, that's a bullish indication. If off of bottoms, you got shallow pullbacks, that's an indication for bullishness. So what I'm looking at in particular is if I look at the move from the top of March 1st to last, I guess, Thursday, March 9th bottom, the pullback is very shallow. It's a rather shallow pullback, and that's an indication this market wants to go down from a trend strength standpoint. If I look at the move, the thrust from a bottom to the bottom on February 24 through the top of March 1st, and you measure the degree of pullback as a Fibonacci, it's 88%. So that's anything less than, anything greater than a 60, 2/3 percentage pullback, I construe to be a deep pullback. So if you look at the succession of, thrust and then pullbacks going back to the entire year, clearly it's this market for the entire, from January of 2016, you got the bottom June 27, you got the bottom right before the presidential election, November 4. If you look at that bottom off of the Friday before the election up to the top of November 25, look at that pullback right for about 6 days into December 5. Very shallow, indicating there's much more life to the bull. You go up from the bottom on December 5, up to the top of about middle of December. Look, that's where the market went sideways for around 3 or 4 weeks there. Very shallow pullback, indicating more life in the bull. You go from the bottom of December 30 up to the top of January 26, very, less than 10% retracement. So the point I'm making, you have this period of thrust and pullback, and a thrust and pullback, all of which the pullbacks are quite shallow. If you look at the most recent thrust from the bottom again on February 24 up to the all-time high, March 1st, and then measure the retracement, it's the first time I've seen a really significant larger pullback. I got to wonder, does that indicate, that suggests to me maybe we're running out of steam, plus the fact I came so close to my price target, 2401 was where was the actual top, and the actual top was 2404, and we hit. I had projected 24. We were just 3 points off. But the other point too is, and I'd mentioned this about a month ago, I had projected when you get stacking of fifth waves from an Elliott perspective, that's another factor. I believe that the top on March 1st corresponds to at least 5 fifth waves, that like a fifth wave and then a fifth wave and a fifth wave. And the more of those you have, the more that improves the correlation that you're at a turning point. Those are my technical reasons why I think we're at a pivotal top. The other factor, kind of recognizing, this is not my first point, but obviously the Fed meets Wednesday. I would say I'm over 90% certain they're going to raise interest rates. I think pretty much that's the consensus on the street. We had a very strong employment report Friday, so it's pretty much an expectation they're going to raise rates. I think we're going to see the typical textbook response. We're going to see pressure on the market because of the rate hike. We had such a strong report fundamentally Friday. I'm wondering, I think it's pretty much discounted in that the market's gonna that the Fed is gonna raise rates. I'm a quarter of a point. I'm wondering if they're gonna raise it more than that. Wow. Is my thinking. Also, but that's a fun. That's just
Fed. Are there Fed funds or something you can look at that would predict that, or
if there is, I don't know how you can. That's what the Fed is going to do. I'm not sure. There may be an algorithm that would do that. Here's going back to the technicals, because that's all conjecture on my part. I've got a not critically important, but I would give it about 65% significance time point for tomorrow in the stock market, 314. My next major one of time turning point is March 29, and then I've already worked out to May 3rd. But of importance for both the U.S. dollar index and the stock market, my next turning point, temporally speaking, happens to be tomorrow. So naturally, the dollar, if you look at the dollar index from an intermarket, trying to figure out what these different sectors of the capital, different capital markets will do, I expect the dollar is kind of declining into tomorrow or Wednesday's outcome, and I expect the dollar to bounce up. But if we look at the price action from Friday through today in the stock market, it's kind of today so far as an inside correlation. So that kind of, I'm not sure, it's kind of a doji on my screen, but I just think whatever is going to, if the Fed does what everyone is expecting, they raise rates, I think that's going to put pressure. Now, again, I got to be objective. I agree with you, Dave. Structurally, the trend still looks like it could overwhelm. I just think right now we're due for a correction. I don't think it's going to be a crash of any sort, but I think we need a correction based on a couple of factors here. Primarily, the idea that the degree of the retracement from if you look at the move up from the bottom on February 24 through the all-time high, March 1st, that's retraced over, over 2/3. It's like at 88 and almost 90% retracement. That's the first time in months I've seen a pullback off of a bottom that exceeded 2/3. That's my primary technical.
Well, I've seen some people do some pretty amazing things as long as the trend was in their favor with their analysis. And so it's good that you point out that some of the stuff you're doing is a little contra trend in analysis. We'll see people give up just literally fortunes is when they stick to their guns in their analysis and they're fighting a trend. And so what I often say is everything works better with trend. But the fact that you recognize you're kind of swimming a little bit against the stream, or a lot against the stream, that's certainly a good thing. Hey, while we have you, let's go ahead and wipe out the question of the week. And
hold on a second, guys.
Yeah, go ahead.
Jim, can we hear you now? Jim, are you there? Okay, I guess his
there goes Jim again. Okay. Well, Glenn, while we still have you, let's go ahead and do the question of the week. And I'm kind of anxious to get to the question of the week myself here. But the question of the week is, what is your best piece of advice for trade management?
Yes. Well, number one, it's always, when you're in it, when you have positions in the market, attempt at least, it's easy, and it's easier said than done, but I always strive to think in terms of probabilities. All of your activity, I expect, should be thought of as far as your trading and your locating for value trades in areas in the market where there's a pricing discrepancy. So always think in terms of probabilities, regardless of the type of analysis, be it technical, fundamental, quantitative, and any subset of such. If you have a price pattern, classical patterns, wave structure, market timing, oscillators, etc., all of the above, recognize that whatever signals you generate from your tools, they are indications of probability. They're on a continuum. They're not absolutes. Differentiate the I would say the macro pattern correlation from understand a macro, an indicator, whatever it is, anything from A to Z will give you a reading, and it's based on historical responses and sensitivities to how markets move. That's great, and then when in aggregate we have a few different of those things lining up, it tends to suggest we have a higher probability entry, let's say. But understand that there could be infinite ways by which a particular macro pattern can be realized. And it's kind of like, the cliche of a guy goes to his account manager or head of the company and says, well, I've developed this perfect system and I guarantee the market's going to be at such and such by such and such. And the guy's response is, oh, really? I've got a big account. Let me just trade opposite your system and push the market, because any one trader, given enough firepower in terms of financial force, in a sense, can alter an outcome that was probabilistically most probably going to occur. And that's why it's so critical to encouch and incorporate good money management. When you look at I got a pattern that says X% of the time, given this setup and this arrangement of things, the market's going to do this. Well, think about the counterpart to that. What percentage of the time is it not going to happen? And realize that the times when you may have a balanced expectation or an imbalanced expectation, a very small percentage of the time the market's not going to do something, think about what it would take for that small percentage to occur. The other thing I always tell people is, always, when you're in a trade, never think in dollars and cents terms, and that's kind of who we are. We're always we're here for the purpose of generating financial return.
Yeah.
But always that creates attachment to certain outcomes, and that could create a perceptual blindness of an interpretation and force us to do things that we know intellectually we shouldn't do. We should always, cut our losses short, is the cliche, let your profits run. Yeah, I know that in my head, but if you're in a position and your emotions can get the better of you, and you might do the very opposite. So a way to thwart that and offset it is try and think in terms of points and percentages, creating a degree of detachment from outcomes, so that you will be better able, you will find an easier path to cut a loss or get out of a trade that's not working with you, or stay in a trade that is working with you and allowing the flip side as well, the positive as well. So those would be the two things.
It's hard to stay with a losing trade, and I don't want to jump in too soon here, but it's hard to stay with a losing trade. But that's the thing to do. I'm looking at my other screen here where I have stops that I thought 3 days ago I should get out, and it came dangerously close to these stops, but now they reversed. And had I went with my fears or gut or however you want to call it, I just would have exited those trades, and now it's like they've reversed nicely. It doesn't always happen, but sometimes it does. I like you kind of alluded to the story of and I don't remember who exactly told it first or who it was, but there was a floor trader who was coming off the floor and he wanted to learn how to do technical analysis. So they had the young there, and he was explaining support to him, and he said the market will not go below this level. And so he picked up the phone and he called his broker. He says, what would it take to push, I guess it was beans or something, below that level? And he's like, a million bushels or whatever the amount was. He goes, at the market. And then the market dove right through that level, and the floor went nuts. And he turns to the guy and says, what you were saying, so all it takes is one guy to mess up a trade. That's why you have to, no matter how great your analysis is, you have to just follow along. Steve, we hadn't forgotten about you over there. What's your best piece of advice for trade management?
It's to use well-researched trading rules to manage your emotions. And so a lot of times we hear that you should always use rules so that you can sleep at night. Well, there's a lot of traders that are just very gifted at discretionary trading. And not every two, there's no two people that are the same. And so you could take someone that has complete control of their emotions amidst all discretionary trading, and putting rules on them, it would just be anathema to their very personality. And we have folks in our office that are like that, discretionary, seemingly no rules, but when you get right down to it, they do have rules that they kind of adhere to. On the other hand, we have students that coming out of the gate absolutely have to have rules for every little thing. And we're talking here about stops, sizing algorithms, properly sizing your position, entries and exits, everything written down, and that's a good place to start. And then if you're a more discretionary bent in your trading, you can kind of back off the rules and start making allowances. So, but trading rules are good for managing your emotions, but they can be tweaked according to the personality of the trader.
Yeah. Good stuff there. I agree with all of that. Very good stuff. It's kind of interesting. This week's question, and I'll share my screen real quick, and hopefully that doesn't become a debacle du jour. It could easily be a column I literally just wrote on Friday. If you go to my website and you click right here, I have a checklist for trading, and it's some of the things that both of you guys have kind of touched upon. The first thing, while that comes up, the first thing I point out is that a lot of things in this week's answers are just flat out wrong, and I would encourage everybody to read them and think about them. Like, well, first of all, the first one, don't lose money. Well, it's impossible to trade and not lose money. Good luck with that. But and then there's like tight stops. Well, universally speaking, I would say that, or from like a broad level, tight stops are probably what makes most people lose money trading, because their stops weren't outside utility of the market, and you're almost guaranteed a loss. And I've fixed, so to speak, a lot of traders by simply suggesting that they loosen their stops a little bit because they're inside the normal volatility. There's a methodology out there that suggests that we should all use an 8% stop. Well, some of my stocks, I got one today has already moved 8% today alone, and sometimes it might move 20% because I tend to be in more volatile, smaller cap stocks, and you could almost be guaranteed to be stopped out if you use the 8% stop. Using an 8% stop is like saying we should all wear a medium-sized shirt, and it's something my fat ass hasn't done since I was 5 years old. But in this aforementioned article, I talk a lot about things like first of all, garbage in, and Steve and Glenn both touched upon that a little bit. Make sure you have a plan in place. Make sure you pick the best and leave the rest. Trading involves a lot of patience, in waiting for a setup, and like the market was, it's intuition or intuition. You got to make sure you're just not trying to make something happen. And then the other patience is waiting for things to unfold and simply following your plan. And again, if your stop is outside of the normal volatility, unfold. Like I just said, I've been watching these positions. I'm looking at them right now for days go against me, and now they've nicely turned around. That doesn't always happen, but following the plan is usually the thing to do. And probably the biggest sin that I see is the micromanagement. So be careful of conventional wisdom. I mean, I can certainly, as you can tell, talk all day on this, but some of the conventional wisdom says tight stops. That's simply not true. Some guy in here says stops kill. Well, stops kill if you're trading a reversion to the mean system, but what are you going to do? You're going to let that position go against you forever, and then you blow up. So there's a lot of things that work until they don't. And I don't want to get off on picking on those guys, Lentz. I'll let them defend themselves. But again, read this article on the checklist and go through these things that I've outlined here before. And trading done properly, as I think Steve might have alluded to, or Glenn possibly a second ago, it almost could be boring if you're just waiting for positions to move. And it's not nearly as exciting as some people out there would try to make it sound. But again, I could talk all day on this because I think it's a great subject. I'm glad. I didn't know it was a question a week until I printed a report right before the show. So I was glad to see this. Read this article, and I think it's going to answer a lot of the questions on that. Okay. Steve, do you have a trade of the week this week for us?
Let me show you a little bit about just teeing off on what I discussed earlier. Let me hit screen share. Is this going to work this time? Let's see. Hit it.
Cross my fingers.
And I click on Metastock. Start screen share. And we're here. Then I go to my option view program. All right. So looking at the statistics of the current market condition, it should theoretically, the chance of it going up and hitting the bullish trading bands, the distribution bands, is, what did we say, one time in 5? And so it follows then, and then the bearish bands, it would hit one time in 3. At least historically, 65 times this has occurred since Jan of 2000. So if those statistics truly play out, you can then construct a bear call spread. And let's just throw one here on in April. And so this is option view we're using, and we're in the calls over here. These are the calls, and we're going out to the April expiry here. And so if you were to sell the, and this is the, let's see, let me make sure here. This is the 2430. Sell the 2430. You're selling it for a higher implied volatility than you would be covering it up here at the 20. So in that sense, you're trading you. Now, when we analyze this options trade, and this is a very simple option spread trade, we go over here to the graphic analysis screen, and so we're looking at 13 days out. Okay, and that's this line here, and of course this is the x-axis is the price of the SPX, and then the y-axis is the profit and loss in 4 different time frames here. And so but we're looking at this line here. In fact, why don't I just go 13 days out? I'm going to cut it to 1 day, and we'll go 13 days out. All right. And so if the market goes down, you could see you could make 13-14% on your money. If it goes up a standard deviation, you're going to lose just a little bit more than that. All right. And so you want to just basically play it 10 to 15 days out of one standard deviation move. If it goes up and hits this, it'll hit it one time in 5. it's supposed to hit the downside one time in 3 more often. And so you can see that we then have a theoretical edge if the statistics play out like this, okay? So that's the idea behind a bear call spread that's judiciously put on with those statistics in mind, given the 1 time in 5 that it should come up and strike these upper levels.
Okay. Let's go over to you. Do you have a trade of the week?
I do, and it's again it's a general kind of a directional play in the bond contract, and I am again underwater here, but I'm hoping and expecting, and I like what you said, Dave. Don't confuse intuition with intuition.
Yeah,
that's a good one.
From Market Wizards or something.
Oh, okay.
Yeah, it's not me. I wish it was.
No, that was. I'm going to use that. Okay. Anyway, I'm going to go along the bonds. If you're on the sidelines, I like a long position in bonds. Now you might say, well, why am I doing that with an expectancy that the Fed's going to raise rates and they're inversely related? Because I've got an overwhelmingly rare, a very rare commitment of traders profile. We've got the commercials at not right now, given the last report on Friday, but the commercials are at close to their largest net long position that they've been in since the summer. And that by itself is not all that unique, or it's pretty common. But what is rare is the fact that simultaneously the small specs are not perfectly, but close to polar opposite. And so that adds to the importance of the net position held by the commercials, which is bullish. I don't know what's going on, but something or things I expect will conspire to bid the price of Treasury instruments up, in spite of the fact that we're seeing, in spite of the outcome, which I'm pretty much expecting as a fait accompli, will be the raising of rates later on Wednesday. It could be a number of factors that would serve to overwhelm a rate hike and still regardless see appreciation in nominal Treasury prices. But from a technical standpoint to support this, if you look at the bottom, and again, I wish I had a chart so you could see this. And guys, I figured this. I need a new plug-in for my Google. That's why I'm thinking I can't show the charts, because normally I can. But we have a thrust. We have what's called a Gartley. Well, it's a variation on a Gartley, a bat pattern, essentially from the bottom in the bond price on December 15 up to the top on January 12th. That's what I'm considering to be an initial thrust. Again, the recent bottom, middle of December, all the way through the top of January 12th. Since then, we've been declining and into the current price, and the amount of the decline is it's what's known as a BAT, which is a subspecial, kind of a subcategory of a Gartley. The outcome of which is the market's more likely going to stop its decline and reverse. Also, this ties in with the other point I forgot, the trading kind of advice, always set up good reward risk ratios. At least a 2-to-1, if not a 3-to-1. So here's my thought. If one establishes one way or the other a long position at current Treasury prices, you can do the Treasury bond, the 30-year or the 10-year. I would go long that right now at current prices and put your protective stop just below the bottom of December 15. So we're talking about a handle, a full point in the bonds, let's say. But your profit, my conservative profit, if I'm very conservative and have a smaller account, let's say 38% of the move down from February 24 to the current price, that's your initial profit. That's already almost 3 times your risk. A little more ambitiously up to the 153 area. So we're trading at 147.5 basically right now, basis the 30-year Treasury. My ambitious target is 153. Okay, so we're talking about a 6-to-1 return to risk ratio on that. Even if you put a limit to take your profits at half of that, at the 151 area, we're talking about more than a 3-to-1 reward to risk conservatively, depending on your the mechanics and your money management stuff. So that's my trade, and I think most traders are expecting further pressure on bonds, given the expectation the Fed's going to raise rates in 2 days on Wednesday. Yeah, but given that profile that I see less than 5% of the time in any given year, over the spectrum of 50 or so domestic, derivatives here in the United States. Very rare. Something or things will conspire, I expect, to lift bond treasury instruments. And so that would be my trade of the week. But if I'm completely wrong, your risk is you're just risking a very small percent relative to your potential return from that reward to risk vantage point. And so that's my trade. I like it.
Yeah,
I mean, if you're, that's what I would be doing.
No, I like getting the risk right. I as a trend follower who takes partial profits, I'm only getting 1 for 1 on the first loaf, but I'm allowing it to open up on the second loaf, to stop, that is, to transfer, to make the transition over to trend follower. And if I do it properly and the market cooperates, then my gains are potentially unlimited. But in your situation, you could map your potential gains out a little bit easier than I can based on your system. But no, that makes sense, and that's where a lot of people get confused, because you'll get these emails about these income producing 90% correct. Well, that'll work until it don't, because what's the old commodity adage? You're eating like a bird and defecating like an elephant. You take a little bitty profits, and all of a sudden you have a big, huge profit. You can be selling a system like that, and you can make a lot of money trading it until you blow up. So as long as you quit before you blow up, you'll stay out of trouble. I was kind of thinking about it. Initially, I didn't have a setup, but maybe I do. But the one thing I was thinking about doing, it's kind of like a trade or a trick, and I think I'm going to show you both. Let me see if I could get this screen shared properly in here. Get this. If you go to my home page on my website, I'll show you a setup. Right here, if you watch this week of charts, we don't have enough time, obviously, to do it right now, but it's about an hour and a half. But in the first hour, I talk about a setup, and we've been talking a lot about Snap lately and what to do with it. But if you go to more posts here, and you'll see me puking a rainbow, this one right here, how to properly trade initial public offerings, easy for me to say, including Snap. And if you scroll down in this article, you'll see I talk about daylight. Screen or not, but in the middle of the page, there's a setup in here, and it's a very simple little setup. The low must be above the 5-day moving average, and I call that daylight because the low is greater than the moving average. You can see the light below. It's kind of a long story about the daylight, but I talk a little bit about this article, and I talk more about it in the video that I mentioned. And then the stock must close at a new closing high. So if I could share my app over to Telechart, I'll show you a live trade that I'm actually long, just kind of experimenting with the system, or the setup, I should say. And this will keep you out of a lot of trouble. There's not enough time to get into it today, but a lot of times IPOs come public and they begin to die out, and they never do go up. And it's kind of like the old Will Rogers adage, buy stocks that go up. If they don't go up, don't buy them. Or you can actually do that in IPOs. If they don't go up, just simply don't buy them. But a few days ago, you could see the low was greater than the moving average, and it was also a new closing high in the setup. And there's also one more caveat to the setup, is that the first day cannot set the new high, and that'll make more sense if you watch the video. But just this little system can keep you out of a lot of trouble in IPOs. And I have an even simpler system, which somebody actually gave me a testimonial about this morning, and they're doing incredibly well. We've been having this IPO bull market for a long time. And so that's my trick of the week, little simple pattern with IPOs, and stay out of the hype, let them establish themselves for at least a week before looking to trade them. And that's it. Let's go back to you, Steve. Any closing comments or anything else? Steve Lentz of OptionView.com. Anything else you want to tell us about OptionView before we leave?
Sure. No. Thanks for having me on the show. I enjoy it as always. Just a reminder, we do have 3 websites to check out high-end option analytics, education, and trading advisory. OptionView at the VUE.com, DiscoverOptions.com, and then the volatility trading advisory is VXX Trading System. Cool. And you can check those out. Lots of information there.
All right. We'll do that. Glenn, to you, Glenn Thompson of PacificTradingAcademy.com. Any closing thoughts?
Sure. Thanks once again as well, Dave. Thanks for having me. It's always a pleasure, and always invigorating and interesting new ideas to kind of manipulate and toss around. And again, you can, if you want to learn more about what we do at Pacific Trading, you can check out the website, PacificTradingAcademy.com. Myself and my coworkers, we teach an array of different types of analysis. I, again, specialize primarily in technicals of all levels of traders, beginners, intermediates, experts, and everything in between. And I do pretty much the array, basic TA, as well as options trading, short-term, long-term. And then some of my coworkers fill in what other, in categories that I might not cover. So you can check us out at the website. And thanks again, guys, for having me.
Cool. Okay, Dave Landry, DaveLandry.com. Go to the website, come to the weekly webinars. You can find all that on the homepage. I would encourage you. I'm proud of those last 2 or 3 posts that I put up, the weekend charts and then my last 2 columns. So check those out, and I think you'll enjoy them. I hope you do. If you don't, let me know, or go have no fun somewhere else. But anyway, thanks again to David Kosmider for having me. Steve and Glenn for being here today. I appreciate that. Jim couldn't make it, but Jim's a good guy, and I'm sure David will have him back on soon. So let me turn the show back over to you, David Kosmider. Thanks again to you and Timing Research.
Yeah, thank you. Yeah, we'll definitely have Jim back on soon. And just want to remind everyone watching, you can, or be sure to hit the YouTube subscribe button and to make sure to get updates on future shows. Also, you can go to TimingResearch.com and download any of the reports or watch any of the past shows there, including this one will be on the site in a few minutes. Also, I've been posting a audio MP3 version of every show. So if you want to download it and listen to it as a podcast, I've been making that available too the last few weeks. And be sure to join us next week. March 13th, or I'm sorry, March 20th, next week. Larry Gaines, Neil Batho, John Thomas, and Dean Jenkins will be here. And just want to thank my guests again for this week. Steve Lentz of OptionView.com, Glenn Thompson of PacificTradingAcademy.com, and Dave Landry of DaveLandry.com.
Thank you.
Thanks,
Thank you, Dave. Thank you, James.